So we've talked about so much about all these different ways of creating a really good, clean investment hygiene. Do you find it easy to follow all the time now that you've created this framework for yourself that should work if you follow it? Do you find it easy to follow, or is it a struggle sometimes?
Well, it's definitely a struggle. Especially like I
really?
said, like work from home is hard, and I can't sugarcoat it. It's difficult. But this is where I think the growth mindset comes in and is really important, because there is no perfection. There's always room for improvement. So, I'm trying to just get a little bit better and have that relentless forward, even if it's very small incremental progress. And that's compounding taking effect. I think there's a mental investment process compounding that can happen over long periods of time of just making little gains. And I think you can't in any one day see the difference, but over a long period of time, it turns into something very meaningful. So, if I have a setback, it's okay. Like, get back on the horse, get back to doing what you know is right. You're going to make mistakes. That's just what happens. You're going to fall down even in your process a little bit, but you know that in general, you're heading in the right direction and getting better. And, having that growth mindset, realizing I'm not ever going to get perfect. I'm just going to try to be a little better than the version I was before. And I think that's important too, is not trying to compare yourself with other people. Compare yourself with you, a month ago. Are you better than that person? And as long as you can always be a little better than the person from a month ago, then you're going to get better. Right. So, it's a journey, just like anything worth doing. And it's hard, but I find it to be very rewarding to know that I'm getting better. So,
God, that's a lesson I've been learning the last few months recovering from this illness. I'm up to 35 minutes now of walking, which is very exciting. And when I tell
next week.
Exactly. And when I tell people who don't know that much about what I've been going through that I'm up to walking for 35 minutes, they look at me like I have two heads, because what adult is proud of themselves for walking for 35 minutes?
Yeah, but in your prime, can walk 30.
I'm doing so well. And it's been, I think I'm able to use this experience to get better in many ways. And one of them is exactly what you just said. Don't compare myself to other people. It doesn't matter. They haven't been living the same life I've been living. And, and that goes in both directions, by the way. You also see people who can run a marathon in, whatever a fast marathon pace is, 3 hours something. And often compare themselves to other people. And that doesn't matter either. Like, let's just be ourselves and try to be a little better than we were yesterday. And that's a really hard thing to do, which is why I'm making this point. Can
I share one more thing?
Please.
For the so one of the most difficult things in this whole investment game is untangling luck versus skill. As we talked about in the first session from last week, with that. It's so random any one year, right? So here's a little secret to kind of getting a better handle on that luck versus skill. Now, it actually comes from a 1950s weatherman, a statistician named Glenn Breyer. And what we're doing here is we're going to track our predictions, and we're going to assign probabilities to those predictions. So let's say that, and how I break it down is on sort of the 5 drivers of where returns come from. So there's revenue, margins, gross margins. There's the earnings, so change in earnings, change in the market multiple assigned to those earnings, and then dividends. So I have these 5 things that are sort of like key drivers of investment returns.
I'm writing these down, so I'm going to interrupt you and ask you to repeat them. Revenue, margins, earnings, and what were the other 2?
Multiple.
So
what the market assigns a multiple to those earnings, and then dividends.
Okay, thanks.
Yeah. So, and technically, like, there's another thing, like with a change in the balance sheet. So like if a company pays off their debt, but we can ignore that for now. So these 5 things that I can make a prediction about each of those 5 things in a probabilistic way. I can say, I think there is a 75% chance that Apple will have 10% higher revenue in 1 year from now. And I tend to make these on an annual basis. And then, so step 1 is making a probabilistic prediction. Step 2 is actually scoring that prediction. Was I right or not? Right. And so if I have a very high probability estimate and it turns out I'm right, that gives you the highest score in this. It's called a Breyer score, based on Glenn Breyer, who invented this. If I give a very high probability and I'm wrong, that gives me the worst score, right? Because that's like you thought you knew what you're doing and you don't.
Mm-hmm.
Now, in between those where you have low probabilities and it turns out right or wrong, that's not really worth a lot because you didn't really have much confidence in what you were saying, right? So what the trick is, and this is why this is like such a good hack, is that for every one data point of returns, which is what I get in a given year, right? Like, what did Apple's stock do in this case? I get 5 data points on these 5 key drivers that tell me, do I know what I'm doing or not, right? So if I'm wrong on all 5 of my predictions and yet the stock went up, I know that was probably dumb luck, right? And that I should probably not think that I know what I'm doing quite as much. Like, this is, if you don't do this and you only looked at what the return was, you're setting yourself up for the big loss later because you think you know what you're doing and you get overconfident.
You're measuring yourself only based on the market as opposed to the more, shall we say, reality-based scorecard that is this.
Exactly. And we can get more data points in a faster time period to see, do we have luck versus skill?
Ah, yeah, true.
So we can, conversely, let's say that you got 5 out of 5, your predictions were right, you had high confidence, and the stock went down. Well, you should then realize, oh man, that was kind of just bad luck. I know what I'm doing. Like, I'm getting the right drivers and I'm making the right predictions. I just didn't get the result that I wanted. But if I keep going, I know that eventually luck tends to iron out, and I think I should end up with a good result. I have some skill here, and it's not just purely luck. So I think that's, especially early on as you're learning and tracking, how you're developing, I think it's hugely important to do these type of exercises.
And it's a way to compare yourself to yourself, which is the core, the exactly touchstone right. that we're looking for.
Yeah, and you don't even have to, you don't even actually have to make an investment in it to track your predictions on it. Like, you could make predictions about different companies, even if you don't own them, to see, do I have any luck or skill, or do I have any skill really in this game? And it doesn't actually have to cost you anything. It tends to be better if you actually have a little skin in the game. That makes it feel a little more real, right? As opposed to paper trading. But yeah, being able to get those data points sooner, I think is hugely valuable.
Well, let's leave it there. I love it. Jake Taylor, thank you so much for being on the podcast. Thanks for sharing your years and years of work and experience to develop this framework and these thoughts around process of investing. I really appreciate that you're bringing this out, and thanks for sharing it with me. I'm using it. It's fantastic.
Well, my pleasure, Danielle. Thanks for having me on and letting me carry on about a topic that I'm passionate about.
You and me both. You guys go follow Jake on YouTube at 5 Good Questions. Jake, where else can people find you?
I spend too much time on Twitter at my handle is FarnhamJake1. And then, check out the Value After Hours podcast. That's me and a couple of my friends who are just tremendous guys and super smart, Bill Brewster and Toby Carlisle. And we just, once a week, we get together and talk for an hour and record it basically, and just sort of whatever's happening. And then, the book is good. Farnham Street, if you want to.
The book is good.
Check that out. A lot of different things a lot of ways to explore if you're interested.
All right. Thanks so much. And thanks everybody. Bye.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.